19. Greg Bolanos is on the line, co-founder and wealth advisor at VestGen Wealth Partners. What other numbers are you looking at? Non-farm payroll, what's on your mind this week, Greg?
Well, I think talking about jobs is always important because we're a consumer-driven economy. And I think what everyone needs to know is the unemployment rate. It's only 4.1%. That's a great headline number, but I don't want our listeners to confuse a low unemployment rate with a strong market, strong job market, that is. I mean, we're increasingly seeing a market where employers aren't firing, but boy, they're not hiring either. So I think the headline number screams 4.1. It's healthy. The fine print, if we pay attention to it, May and June jobs, those just got revised down by 103,000. And in July, we actually lost 23,000 jobs. So I think the short answer here is we really got to start paying attention to the jobs.
What does that say about wages then?
Well, you know what? Near term, we have seen real wage growth actually turn negative due to the spike of inflation. I was so proud of this country because after suffering under very serious oppressive inflation in 22 into early 23, we made a corner where we actually had real wage growth. And now what we've seen in the past several months is real wage growth turning negative again. So we're fighting a war on several different places, but in this environment, I don't expect wage growth and large pay increases to be happening anytime soon. And that is going to continue to show up, I think, in some of the consumer numbers as people move from being what I call discretionary spenders to necessary spenders.
Yeah, people are feeling it. Gas prices look like they were on the way down, but now they've gone up just a little bit. Beef is still expensive. We've been talking a little bit about that on the show. Some staples are reasonably priced again, but overall, the grocery cart is still very expensive, isn't it?
The grocery cart's incredibly expensive, and the market's been really focused on just the total amount of spending because the total amount of retail spending has been fine. The total amount has been very adequate. We know that the spending is not evenly distributed across the American populace. And I think anytime the spending is going to come from too narrow of a group, it also makes it more fragile where we have to look at the wealth effect and other things where if we do end up getting bouts of stock market volatility, is that going to finally show up in the retail spending when those who have so much begin to pull back? But again, I tell everybody, don't take this as a piece of negative contention. The intermediate term trend of this market remains bullish. People just need to expect more volatility going forward, especially with a new Fed.
So up and down, but mostly up. And in what sectors? Is it retail? Is it all still energy and data? What's driving the market right now?
Well, AI, artificial intelligence, is still the market's engine. That's good and bad. So I think the question I talk about with investors all across the country is it's not whether or not you own AI. The question is whether you own too much AI. And I want people to actually be a little contrarian. I think one of the great contrarian ideas is think about software. Sometimes the best place to look in technology is not where everyone is looking. It might be where everyone gave up, a.k.a. software, the SaaS apocalypse. And then the breadth, John. You said what other sectors? I'm excited. We've got 9 of 11 sectors positive for the year. We got small caps actually outperforming large caps in a significant way. And this is a market that's no longer dependent on the Mag 7. So take a look at a multi-cap global approach and your portfolio will become more durable.
You are not advising people to change their mix or are they kind of rejiggering it, 60-40 or whatever the numbers and percentages are?
Well, I think the biggest thing is everyone should have a retirement plan and everyone should have an overall asset allocation that's tailored to that retirement plan. So if your retirement plan calls for you to be 60-40 or 70-30 stock to bonds, as you allude to, John, I just want people to be periodically rebalancing back to target. Because if you're not rebalancing, the equities have run away here. And for as much as I say the bond market's the bigger story, because the bond market's telling a story that we need to be careful, If you're going into retirement, this is fantastic. You can lock in these higher interest rates for longer and just clip coupons. So don't think that bonds are bad here. Bonds are a great opportunity for retirees to lock in the interest that they want. Just do it in the right platform.
What percentages, what kind of returns should people be expecting?
Well, in terms of stocks or bonds, if someone says in terms of bonds, I want everybody to make sure that their bond portfolios are always giving them a real return. That's a return after you adjust for inflation and a return after you adjust for taxes. So I encourage everyone to do their homework on whether they should be in taxable bonds or they should be in muni bonds. And then I encourage people to build portfolios where they can get yields to maturity in bonds that are averaging in that 5 to 5.1% space. That's very, very doable. And then as far as the equity side of the ledger goes, I'm so sorry, John, it depends on where you're investing for growth, but can people still get double-digit earnings per share translating into the stock portion growing double digits? Yes, that is still tenable in today's market.
One last thing, you did say something that I think puts a little cold water on all of that, and that is, but remember, you've got to, if you think you're going to lock in 5%, or if you're hoping double digits on equities, remember you're going to pay taxes, and inflation will eat into your earnings, right? So maybe the safe harbor, I wonder if some people will be happy to say, okay, if I come out even, I'll get 5%, but the inflation and taxes will eat up the 5% I've gained. At least I haven't lost anything. I wonder if that's the mindset of some of your investors.
Well, I think the mindset of our investors at VestGen Wealth Partners is everybody knows it's not about nominal returns. It's not about the paper return. At VestGen Wealth Partners, it's about real returns, John. It's about protecting purchasing power. I mean, if people want to get retired, no one's going to spend a percentage. People spend purchasing power. And that's why I think we need to have well-curated institutional models, not just of stocks and bonds, but I think there's other assets that should be a part of it. We should be talking currency. We should be talking commodity. We should be talking precious metals. We should be talking about real estate. We should be talking and invoking hard asset, low obsolescence infrastructure, because all of those will contribute to the concept of real return investing.
Craig Bolanos is the co-founder and wealth advisor at VestGen Wealth Partners. GetRetiredStayRetired.com is where you find him. Okay, Craig, we'll call again. Nice to talk to you today. Have a good weekend.
Thanks so much, John.